I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading major trend reversal tops. An important thing about tops is that you need strong bears to make a reversal. I'm also going to talk about the minimum targets that you should be considering. When traders are looking for a higher high major trend reversal, they need some evidence that the bears are reasonably strong. Here we have a bull trend and a potential higher high major trend reversal. Look at this. We have a rally lasting a couple of legs, the third leg. Chances are, once the market's always in long, the first reversal down will be minor, which means it'll become either a bull flag or a trading range, not a bear trend. And now we have another strong leg up, and therefore any reversal down again will probably be minor. But look at this reversal. It went sideways for about 15 bars or so, and it broke below the bottom of the bull channel. And we have a decent bear bar here and a decent bear bar here, 2 legs down. The bulls lost control of the market for a lot of bars, and the bears were strong enough to break below the moving average and stop the bulls for about 15 or 20 bars. When that's the case, that is enough selling pressure so that traders will suspect that the next reversal attempt, instead of being minor, leading to a bull flag, it might be major and last 20 or more bars and go down for a swing. In addition, not only did the bears stop the bulls for 20 bars, they were strong enough to put a couple of bars completely below the moving average. There's a gap between the high of this bar and the moving average, a gap between the high of this bar and the moving average. If the market's in a bull trend and now the bears are getting strong enough to put bars completely below the moving average, then the bears are reasonably strong. So yes, minor reversal and bull flag and bull trend resumption, but after gap bars, the market usually tries to form a major reversal, and therefore traders will look to sell a reversal down from testing the bull trend high. Here's the top of the bull trend. We're breaking above it, and the breakout's failing. Traders will sell below here, betting that there's a 40% chance for a major reversal, a reversal down where the reward is at least twice the risk and usually lasting 20 or more bars. Traders need the minor reversal to be strong if they're going to start looking for a major reversal. And it doesn't have to lead to a big reversal down. It can simply be the bears stopping the bulls for 10 or 20 bars, as they did here. That is enough strength on the part of the bears for traders to think that the next reversal attempt might be major and not just minor. We have a double bottom bull flag. Every double bottom is a high 2. So a bull trend, bull breakout, pullback, resumption, a double bottom, slightly lower low. And when you get a double bottom bull flag, a high 2 bull flag, 20 or more bars into a bull trend, late in a bull trend, you have to be thinking that the next leg up might be the final leg and that the high 2 bull flag might become the final bull flag. The final leg here, we have a bull bar, not especially big, bad follow through. Another good bull bar, bad follow through. We have a third bull bar, bad follow through. So even though it's a bull micro channel, no pullbacks lasting about 8 bars, the rally is not as strong as you might think when you see a bull micro channel. Whenever you get a bull bar and bad follow through and you get several like that, the leg up is probably a bull leg and what will become a trading range and possibly a major trend reversal. We have a double top. I said we have a double bottom. We also have a double top. The market tried to reverse here. Instead, we broke out. And this rally with that bear bar might be a failed breakout above the double top. Anytime you have a double top and then a breakout that starts to reverse, it's a type of a wedge. You have 3 pushes up, 1 pullback 2 for the double top, pullback 3. It's 3 attempts to go higher, even though it does not look like a wedge at all. It's the same forces that operate with a wedge, and therefore you can expect the same kind of reversal that you can expect with a wedge. There is a wedge, in fact, here as well. Rallied, sold off, rallied, sold off, and now we're at the top of a channel. Again, if I drew a trend line along the bottom, it wouldn't look very much like a wedge, but it's 3 pushes up and we're getting a reversal down from the top of the channel. And there's also a parabolic wedge here as well. Bull bar, pause, bull bar, pause, bull bar, reversal. So this is a wedge and it's within a larger wedge. And then we have a breakout above a double top that looks like it's reversing, and that is a type of wedge as well. So smaller wedge patterns inside of a larger wedge pattern, that means nested wedges, that has a higher probability of leading to a reversal. You can also draw a wedge from the low. We have a leg up, pull back, second leg up, pull back, and a third leg up. Again, does not look like a wedge, but it's 3 pushes up. Some computers will look at this as the wedge. Other computers will say the wedge is here, even though this low is below this low. In other words, the first high of the wedge came before the end of the bear trend. It's still a wedge. Markets often transition from bear trends into bull trends, and during the transition, they have components of both. So yes, we're still in a bear trend here, but some traders would say the bull trend began here before the bear trend ended. At least that's how I would look at this. Some computers would also look at this as a wedge, a rally, a pullback, even though it's a pullback below the bull breakout, and then a second leg up, and then a pullback, and then a third leg up. And as I said, there's also a parabolic wedge. Many ways to draw a wedge, all reversing at the same point. Nested wedges increase the probability that you'll get at least a couple legs sideways to down. We have a negative gap. We have a high here, and we pull back below it. We pull back below it a little bit as well. Some overlap of this trading range with this trading range. However, the overlap is not especially great, and therefore this can lead to a measured move up. Whenever you get a pullback below a breakout point, I view that as a negative gap. So instead of an actual gap, I call it a negative gap. Here's an actual gap, this low, that high, no overlap. There's a gap here between this low and the buy signal bar high. That is a gap. Here we have overlap between the breakout point and the pullbacks, negative gap, but it still often leads to a measured move. And therefore, I'm always drawing lines to see how the market behaves near that resistance. And you can see the market's trying to reverse. This is a good-looking sell signal bar, a bear bar closing on its low. That further increases the probability that the bears will get at least a minor reversal. Selling here, you probably have about a 40% chance of a swing down. It's a fairly strong bull trend here. We have about an 8-bar, 9-bar bull microchannel, and we do not have a micro double top. However, if you want higher probability, you wait for maybe 3 or 4 consecutive bear bars. At this point, we have a higher probability of at least a small second leg down. It's reasonable to take this short. The risk is to just above the high of the bar. You might use a wider stop in case there's one more small leg up, but the risk is small compared to the potential reward. Even though the probability of a swing down is only 40%, the reward is sufficiently big to offset the lower probability. The market's clearly still always in long at this point. And that is why the probability is only 40% that the reversal will be successful. If you wait for 3 or 4 consecutive bear bars or a pair of decent bear bars closing on their lows and then sell, either that close or above these bars, looking for at least a small second leg down. The probability can be 60% or more that you'll get some kind of a swing down. At this point, the market probably is always in short, meaning that the bears have taken control and we're probably going at least a little bit lower. If you short here, your stop is further away, your risk is greater, your reward is less because you're entering after the bear trend has already begun, but the probability of making money has gone up. And that's the trade-off. Whenever you enter when the trade has higher probability, your risk reward is always worse. You never get high probability with good risk reward. You get one or the other, but never both. There has to be a reason for an institution to take the other side of the trade. Anytime you take a trade, you have to have a plan on how to take profits. I always operate with the idea of a minimum profit. What's the smallest profit that I need to have a positive trader's equation? What's the smallest profit that I can go for so that the math makes sense and I should take the trade? We're getting late in the day. Traders will look for reasons to take profits, especially since the rally is not particularly strong. On any trade, the minimum target is always 2 times the actual risk. If you sold below the low of this bar, you entered on this bar, you actually only had to risk to above the high of this bar, so you risked very little. Mathematically, it's always reasonable to take profits at 2 times your actual risk. However, if 2 times your actual risk is smaller than the minimum scalp, that does not make sense. Also, the minimum reward is rarely the best reward. The minimum is just the minimum needed to make the trader's equation positive. Like anything in life, going for a minimum is not always the best choice. And if you're taking profits consistently at the minimum level, that is not a good thing. When the actual risk is very small like this, it's better to be looking at the initial risk. If you sold below the low of this bar, your initial stop is above its high, and that generates your initial risk. That's your initial risk. And taking a reward, at least partial profits at 2 times your initial risk, makes sense mathematically. That's better than 2 times actual risk when the actual risk is tiny like it is here. Also, you're taking profits around a 50% pullback. The bull trend might resume. And you're also taking profits at the moving average. So it's reasonable here to take profits at 2 times the initial risk. You're also at the bottom of the final buy climax bar, and the market often pauses or even resumes up at that point. We have a bear spike, a bear breakout, second push, third push, and now we're getting a second reversal up, first reversal up, second reversal up, and we're getting near this low, the bottom of the final bull leg. We might be entering a trading range. We're also getting late in the day. It's reasonable to take profits here as well. The final possibility is holding until the end of the session. Here we have a double top bear flag, and we may get a collapse into the close. We probably will not. It looks like this was resistance. We turned down, and then it became support, support. We're probably in a support level, and we probably will not break strongly down, but it's reasonable to hold short until the close, just in case we do. Theoretically, if a bull got out above this high or that high, and he's trading always in, he always wants to stay in the market. He has to sell again below a reasonably strong bear bar, which is below this bar. The market's still always in short. It did not become always in long here. So if he's trading always in, he has to sell again here, and then he would get out at the end of the session. Whenever there's a third push up, traders have to be prepared to sell a breakout. We're trying to get a bull breakout above a bull channel. 75% chance it's going to reverse within about 5 bars. Here, it reversed within a couple bars. If you have a channel that's reasonably broad, the legs going down lasting 5 or 10 bars, then selling the reversal down makes sense. If the channel up is extremely tight, like this, selling a reversal down does not make sense. Probably the reversal will be minor, and the best the bears will get is sideways. Again, if the channel is very, very tight like this, the first reversal down is probably minor. You're not going to make much profit if you make any profit at all. The same right here, probably not much profit. But here, the bear legs are lasting 15 bars, 5 or 10 bars, and traders are making money selling at prior highs. If they sold this high and sold more higher, they would make money. The pullback here fell below the breakout point. Chances are, if you're selling here above these highs, at a minimum, we'll pull back below the breakout point. We have a bull trend, fairly tight bull channel. We sold off about 10 bars or so. Possibly this is a double top, lower high, major trend reversal. It's reasonable to take that short. It would be better if this bar had a bear body and if we had more selling pressure. Micro double top, that's good. That increases the probability of success. But this rally up to this bar is about 9 bars without a pullback. This is the first reversal down, the first time a bar went below the low of the prior bar. That makes this a lower probability short, even though it's a micro double top and a lower high major trend reversal. Bull channel, very tight. On a higher time frame chart, this would be a series of bull trend bars, and this would be a very brief breakout. We have one bear bar. If you take this one bear bar out of the chart, there's really not much selling at all. Again, a 10 bar bull micro channel. Probably the first reversal down will be minor, and the bulls will try to get resumption up. And then additionally, the sell signal bar has a bull body. Again, low probability sell. This bear breakout is below a tight trading range, but it's a 1 bar bear breakout. And look at the follow through bar. The next bar has a bull body, and the bar after that has a bull body. This looks like a failed bear breakout. That is not much selling pressure. We went sideways for about 10 bars, but the bars are small and the pullback is small as well. Therefore, there's not much sign that the bears are particularly strong. If you want higher probability, better to wait for more selling pressure or for a strong bear breakout and then sell after you see a very big bear breakout. And you can see what happened. Instead of a reversal down, we have a small double bottom bull flag and trend resumption up. If you had shorted below this bull bar, the market's still always in long. It never became short here. The bears did not get follow through. And therefore, if you sold below here, you have to exit above a bull bar. We have a double bottom bull flag and trend resumption up. We have a bull flag here, a break above the bull flag, and then a small bull flag after this breakout. You have to get out of your shorts here because this is exactly where bulls will get long again. If the bulls exited below this tight trading range with this bear bar, they'll buy again above a bull bar, above here, above here. If the bulls exited below this micro double top, it's still always in long. Therefore, they have to buy again above a bull bar, and they have a bull bar here. You cannot continue to hold short if the market is telling the always in bulls to get long. Bull trend, bear breakout, higher high. Is this a higher high major trend reversal? Well, look at this channel. We're up for 30 more bars. I think you have to start the process over and look at this as a new bull trend. And this is not much selling pressure. And therefore, this is probably a minor reversal. You can say it's a second entry short and went below this bull bar, tried to resume with this doji, and now we're getting a second entry short. I would not call this a higher high major trend reversal. I would call it a minor reversal, and more likely we're going to go sideways rather than down. $20 in a very tight bull channel. I would call this a resumption of the bull trend. I would view this as a new bull trend, and therefore I would need another sign of strength by the bears, a resumption of the bull trend, and a failure around the prior high. This reversal is more likely minor, and it probably will become a bull flag, and the bull trend will probably resume. Whenever you get a trend resumption lasting 20 or more bars, start the process over again. You have to again look for some sign of strength by the bears. If you did sell this and you were stopped out within 5 bars and then there's another sell signal later, that would be a higher probability sell, but that's not what's happening here, at least not yet. This is a strong bull trend, a tight bull channel. Chances are we're going higher. Eventually, every trend ends. However, there's no reasonable sign of a top yet. And a lot of times the market will make several attempts to reverse before it succeeds, trying to reverse here, 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 again here. But none of it is strong enough to lead to a trend reversal. Now this is good for the bears. They have a strong leg down lasting 10 or so bars with many bear bars, some big bear bars. After this, traders will look to sell a major trend reversal around this high. Maybe here, but you got 3 bull bars, one pretty big. Maybe here, 3 more bull bars, not very good. But here we have a bear bar closing on its low. We have another bear bar closing on its low, a micro double top, and a wedge. This would be a higher probability short for a major trend reversal. Reasonable to sell on a stop below the low of that big bear bar. We have a micro double top, and we have a wedge higher high, and we have good selling pressure on the part of the bears, and we have 3 pushes up, 1, 2, 3. Reasonably good breakout below the bull trend line, and trend resumption up. Even though we have a lot of bull bars, we're getting some hesitation on the way up, and we have a wedge rally. If you do sell below this bear bar, it's reasonable to put your stop just above the high of that bar. That is your initial risk from your entry below this bear bar right here to your stop just above. In this particular case, that's 10 ticks. This is a fairly tight channel and a new leg up, but it's within a broader channel, and you're getting much more selling pressure here, here, here. Therefore, there's a higher probability that the bears will finally get a major reversal, a couple legs and 20 or more bars down. Lots of prominent tails, all representing balance between the bulls and the bears. Bulls are selling at the highs of a lot of these bars. Bears are selling at prior highs. We're getting increasing selling pressure. And nested wedge. We have a wedge 1, 2, 3, and we're reversing down. You can also draw the wedge 1, 2, 3, trying to get a bull breakout above the wedge. You can draw the wedge 1, 2, or 2 and 3, or 1, 2, 3. I talked about tops needing strong bear bars. They need some evidence that the bears are strong enough to take control. And then I talked about minimum targets when you're taking profits. You should always go for at least 2 times your actual risk. And if your actual risk is small, then go for 2 times initial risk to take partial or full profits. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading major trend reversal tops. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading major trend reversal tops. Whenever you're in any trade, you always have to have a plan to take profits. Major top, so expect 2 legs sideways to down to some kind of a support level, maybe this high or low, maybe here, maybe all the way to the bottom of this wedge. Plenty of room for a profit if we get down to the most recent major high or low. Major because it led to a new high and it had a lot of decent bull bars on the way up. It's still a bull trend as long as it stays above the most recent major high or low. However, at this point, a bear breakout, decent follow through, wedge top, the market's probably always in short and we'll probably get at least a small second leg down. This might be the second leg, this might be the second leg, or this could be the first leg and then a triangle and then a second leg. You don't know for sure until you see it play out. A trading range around a 50% pullback after a wedge top, that is common, but it's still reasonable to hold short. Part of the reason for this trading range is the bears who sold below this bear bar had a risk here, and 1 times their actual risk was here. Some of the bears took profit at 1 times actual risk because they were disappointed by these bull bars. They were afraid that instead of a reversal into a bear trend, it might simply be a bear leg into a trading range. It's reasonable to take your profits at 2 times initial risk, which would be down here. 2 times actual risk, I don't have it drawn in. You sell below this bar, you get filled here. Your actual risk is to just above this high. And this is probably around 2 times actual risk. It's reasonable to get out here. We have an attempt to reverse back up, probably a second leg down from this bear breakout. Well, this is a second leg down. It's reasonable to get out above this bull bar. Here we have a failed breakout below this small double bottom, and we have a micro double bottom. Also reasonable to get out above this bull bar. Even though it's only 1 times your initial risk and you really wanted 2 times, it's reasonable to get out. You can stay short, keeping your stop up here, maybe above the top of this bull bar. But if you stay short after the market is trying to reverse up like this, you have to keep your stop at the appropriate place. Don't panic out and just rely on your stop. Also, whenever you have a wedge top and you get a reversal, the reversal usually lasts about half as many bars as there were in the wedge. Here's how many bars in the wedge, and this is not quite half, and therefore we still might get more down. This might simply be a triangle pullback after the first leg down, and then triangle pullback, and then we might get a second leg down. Remember, most major trend reversals only have about a 40% chance of a swing profit. And it's always reasonable to take partial profits using limit orders at support. And one support would be 2 times actual risk. Again, actual risk is from your entry price to above the high of the pullback. And this would be around 2 times actual risk. You sell below this bar, you get filled here, this pink line. Your actual risk is to 1 tick above the high of this pullback bar. If you had a stop there, you don't know that in advance, but if your stop actually was there, that was the total amount that you actually risked from your entry price to that pink line, and 2 times actual risk is right here. Your actual risk was only 7 ticks, and 2 times actual risk is 14 ticks, and as long as it fell 15 or more ticks from your entry, you could exit at 2 times actual risk, and therefore taking partial or full profits right here makes sense mathematically, and that's part of the reason why we're reversing here. Bears taking partial or full profits. But look what happened. The bears who held short relied on their stop, and they sat through all of this, got a windfall profit all the way down to the bottom of the chart. If you did get out for any reason, you have to be looking to sell again. You could sell on this strong bear reversal, 2 big bear bars, or you could wait until the close of this bar. At that point, the odds are high that we'll go at least a little bit lower. Whenever you have a wedge top, you're looking for 2 legs down, and if the legs look too small, then they're probably simply part of a bigger first leg. Then you look for a bigger second leg down. And therefore, it is reasonable to hold short even after these strong reversal attempts. Whenever you have a higher high major trend reversal, in this case a wedge, you always have to be thinking that it probably will be followed by a lower high major trend reversal attempt. We tried to get a double top bear flag here, a double top lower high, did not work. And then we have another attempt at a double top or an expanding triangle top for a lower high. Okay signal bar, but we went above it. Not really good stop entry selling unless you're going to use a stop up here. Tight trading range, 30 bars sideways. Nothing is clear until you get a couple strong breakout bars. If you sell at this point, higher probability, stop further away, less profit remaining in the trade, but reasonable to sell if you can react quickly. One of the problems is if the market's in a very tight range like this for 20 bars, it's easy to not be ready to trade. And therefore, when you get this breakout, it's hard to sell. But with experience, you can do that. Whenever you do get a lower high major trend reversal after a higher high major trend reversal, it often is basically a tight trading range. But within it, there's often some kind of a pattern, like an expanding triangle or a double top here, a bear reversal, and then a small wedge rally. If you're prepared for a bigger second leg down, you can be selling. Expanding triangle, and you could sell below this bar and put a stop up here. If I sold below this, I would probably keep my stop up here. You get 2 bull bars, a decent sized bull bar, might go a little bit higher. You're betting on a lower high major trend reversal and a second leg down after the wedge. I think the best stop is up here. A small wedge lower high after a bear reversal. If you want, you can call it a nested head and shoulder stop. Left shoulder, head, right shoulder, and the right shoulder subdivided into a smaller head and shoulder stop, left shoulder, and then a small double top for the head, and then a small right shoulder. Tight trading range, you can see all kinds of patterns. You can see buy patterns and sell patterns, but it's reasonable to take the short because there's at least a 40% chance you're going to get the bear breakout after the wedge top. There's a 40% chance you're going to get bull trend resumption up. And then 20% chance you may just stay sideways for a lot of bars, maybe to the end of the session. Again, if you're quick to understand what's going on, you just sell the close or simply sell at the market. A lot of times you don't have time to sell the close exactly. So when the bar is about to close or as soon as it closes or right after it closes, you just hit sell the market. The bulls are giving up, the bears are getting aggressive. You don't want to be looking to buy for at least several bars. Whenever the risk is small, for example, if you sell below this bear bar and put your stop above the high of that bar, you have a low probability. In general, whenever you have a small risk, it's a mistake to put your stop right above the top of the signal bar. It's better to use a wider stop, measure move up, or look to the left for some alternative stop. Since we have a wedge top and 2 legs down are likely, it's reasonable to put your stop here. Also, the swing bears who sold up here and are holding short do not have a reason yet to use a tighter stop. If there's a strong bear breakout, then they can lower their stop. But all through here, the correct stop for the bears is still up here. If you did sell below this bear bar and you get stopped out, you got to look to sell again. For example, on the outside down, because at that point we have a micro double top, or on the close of this bear bar. Anytime any stop is hit, there's a 50% chance that the bull breakout will continue higher, and 50% chance the breakout will fail and reverse back down. It's very common for the market to have strong moves in the wrong direction. In other words, they appear to be going one way, that attempt fails, and then you have an even stronger move in the opposite direction. Here you have a strong bear breakout, bad follow through, and we got a reversal back up. Experienced bears, instead of getting stopped out here, they'll sell. They see that people made money selling at this high. They made money selling at this high. They'll be selling at this high, putting a stop above here. This is the most recent major top, and therefore bears selling for any reason would put their stop up here. Again, half the time if a stop gets hit, the breakout will fail. It's simply the market probing, testing the strength of the bulls and the bears. Either you get a bull breakout and the bears give up, or you get a bear reversal and the bulls give up. In this case, the bulls gave up. As I said, you could put your stop above the high of this pair of bear bars. Weak bears will do that. Strong bears will keep their stop up here. And strong bears will be selling above bars. They sold at this high right here. They sold above this high right here. And strong bears will sell with limit orders at this high as well and put their stop right here. Weak bulls will be buying these breakouts, hoping that the trading range will convert into a bull trend. And that's usually the worst thing to do. Selling at the bottom, buying at the top. Strong traders do the opposite. They buy at the bottom and they sell at the top. There's simply not enough bulls to get the bull trend to resume, and the bulls are giving up and the bears are winning. And then this strong breakout is a sign that the bulls are finally giving up. This is a give up bar, a big bear trend bar, consecutive bear trend bars. And you can see when this bar opened, it opened below the close of that bar. Traders were selling. As soon as the bar closed, they sold. Same here. The open of this bar is below the close of this bar. Aggressive selling. Bears are selling to get short. Bulls are selling to give up. If you did hold for leg one, pullback, leg two, and now we're at the bottom of the entire bull trend, and we're getting a reasonably strong reversal up and a micro double bottom. We went down on this bar and then up, down on this bar, up again, and a pretty good bull reversal bar. It could be simply a two-legged move and a big trading range. Leg one, pullback, leg two. This could be a large second leg trap. It's reasonable to get out above the high of this bar. Even though it's probably a minor reversal, it could lead to an abrupt reversal. We were in a tight trading range here, so some strong bulls will buy at the prior low. They'll buy at this low, get filled here for a scalp. They'll buy at this low, they get filled here. And they'll buy at this low and they get filled here, and they do not panic out. Some bulls will hold short, and then when there's a strong bull bar, they'll buy more above the high of this bar, expecting the market to come back to their original entry price, which it ultimately did. If you sold here and you took profits here, you made about 8 points. Can you wait to take profits? If you do, at this point, I think you have consecutive good bull bars. You have a reversal up from the bottom of a possible trading range, it's reasonable to exit there or even exit here. If you did not get out here, I think you have to get out here, and certainly no worse than here. We have a bull bar, a bull follow-through bar, even though it's a doji. You have to have a reason to get out, and the market is probably always in long at this point. I think it's almost certainly always in long at this point. That means we're probably going at least a little bit higher, and you don't want to take a chance that you're going to give back all of your profits. This is probably the best exit. We're reversing up from the bottom of the chart, possibly the bottom of a trading range, and trading ranges often have two legs, one pullback, two, and the second leg is often very strong, making traders believe the trading range is converting into a bear trend, when in fact it could simply be a second leg trap, a very strong second leg trapping traders into selling at the bottom, and then the market reverses up. You have to be prepared for that. If you have a big windfall profit like this, you have to take at least partial profits. I would get out of everything above a good bull bar, micro double bottom, failed breakout. Bull trend, bear breakout, higher high, major trend reversal. We have a 20 or 30 bar very tight channel. This is probably a minor reversal, which means the best the bears probably get is a trading range and not a bear trend. It's pretty common when you take a short to have the market come all the way back to your entry price. Part of the reason for that is the bulls will look at this and say, it's a minor reversal. I'm going to buy the low of that bar and put my stop down here, betting that the reversal will not get down here, and I can buy more lower if it goes down, and I can get out break even because it's probably going to reverse up and form a trading range. If a bull buys here and it goes right up, he makes his profit. If he buys here and puts a stop down here, he can buy more lower, betting that it'll come back and test his original entry price. Very common for the first reversal up to go up to the low of the sell signal bar, which is one tick above your entry price. You enter one tick below that bar. And it's very common for the pullback to hit your entry price and stop you out if you have a break-even stop. Strong bears, if they're expecting a major trend reversal, they'll rely on their stop above the top of the bear trend, allowing for the possibility that this is simply a test of the breakout price, a test of the entry price, trapping weak bears out. However, if you see a strong reversal like this, a strong bar like this, and now we're getting a third reversal up, we're still forming a higher low in a broad bull channel, you have to get out. You could get out above this bull bar. It did not go above this bull bar, but now we're getting another reversal attempt. So had you shorted this, hoping for a swing down, you have to get out on some kind of reversal. Here you got a third push up, a small expanding triangle. Here you have a bull bar. I would definitely get out above that bull bar if I did not get out above here or above here, because this is probably a minor reversal, not a major reversal. There are too many bars up since the first bear break below a trend line, and therefore you have to start the process over again. Whenever the market comes up and hits a break-even stop, and then the bear trend resumes like this, you never want it to get back to the break-even stop a second time. If it does get there, you're usually going to get higher prices. We have a gap up and a bull trend, and we're working higher. We have a new high here, a first reversal down, and now we're getting a second reversal down. You can argue wedge top, 1, 2, 3. However, look at the channel, this rally. How much selling pressure is there? We got 3 bars here, 3 bars here, 3 bars in the pullback here. But how deep are the pullbacks? How big are the bear bars? The pullbacks are very small. This is a small pullback bull trend, and selling reversals from a new high probably will result in a minor reversal, and a resumption of the bull trend. Bull trends are always forming wedge tops. Bear trends are always forming wedge bottoms. 80% of them fail. Weak sell setup, certainly for a stop entry short, and therefore it's a bad sell. Better to wait for a stronger sell setup. Almost certainly there are more buyers below this sell signal bar than sellers, and we're probably going higher. They bought at the low of this bar, made money, even though it pulled back a few bars. They bought at the low of these bars and made money, even though it pulled back a few bars. And that's probably true here as well. They'll buy below that bar, buy below this bar, betting that the bear reversal attempts will fail and the bull channel will continue higher. We have a bull trend, a buy climax, and a couple legs sideways, maybe a triangle, 3 pushes down, 1 pullback, 2 pullback, 3 pullback, and trying to resume up. And now we have a small double top, higher high, major trend reversal, and a second entry sell. First entry, second entry, even a third entry sell. Now, is this a good major trend reversal setup? You could say, well, Al, it broke below the bull trend line and went sideways about 5 or 10 bars. Yes, but how close did it get to the moving average? Where are the consecutive big bars? We have a pair of consecutive big bars here, but this is probably a pause after a buy climax, and then we have trend resumption up. Not much selling pressure at all. The pullbacks are small, lasting 1 bar, lasting 2 or 3 bars, and they're not falling very far at all. This is a small pullback bull trend, and on a higher time frame chart, it's a bull breakout. On a higher time frame chart, this looks like this, and it's a low probability bet when if you're looking to sell. Calling this a higher high major trend reversal is a mistake. It's not a major reversal. It's a minor reversal, and a minor reversal usually becomes a bull flag or a trading range. A minor reversal, you get trend resumption up. Minor reversal, trend resumption up. Minor reversal, trend resumption up is much more likely than trend reversal down. The market has not touched the moving average in 20, 30, 40 bars. So a 20 gap bar buy setup. Probably bulls will buy the first touch of the moving average. A weak sell setup, and therefore better only to look to buy. And you can see when it got down to the moving average, you got 4 consecutive bear bars, all closing below their midpoints, but there were buyers at the moving average. And now we have a high 2 bull flag at the moving average. These are buy setups, not sell setups. Also, we have a negative gap this low, barely pulled back below this breakout point, and a negative gap common in small pullback bull trends. Traders will buy the resumption up, looking for some kind of a measured move up. Whenever you take any trade, you should always have some idea of where you'll take profits and under what circumstances you'll take profits. You always need a plan. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading major trend reversal tops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading major trend reversal tops. In this video, I'm going to talk about lower high major trend reversals. We have a gap up, which is a type of a bull trend, even though it's only a gap and very brief. If you looked at the cash index, you would see a big bull trend bar from here up to here. And therefore, it's a strong bull trend, a strong breakout. While the bulls were strong enough to create a big gap up, they were not strong enough to get good follow-through buying. We have 11 bars down, many good-sized bear bars, consecutive bear bars here, 3 bear bars here, 2 closing on their lows, both with good-sized bear bodies. This is pretty good selling pressure, a pretty good sign that the bears are reasonably strong, despite the big gap up. And because that's the case, the market might be in a trading range instead of a bull trend. And if it's in a trading range, a rally up in that range could lead to the beginning of a bear trend, a reversal. The market's rallying, and we have a low 2 short, low 1 here, low 2 there, but a very tight bull channel. And usually when you get a reversal down in a very tight bull channel, the reversal is minor. Is this a lower high major trend reversal? Of course, we have a bull trend, we have pretty good selling pressure, and now we're rallying to a lower high. However, because it's in a very tight channel, it's more likely a minor reversal and unlikely to lead to a bear trend at this point. For the bears, they can take this sell, but the probability is not yet particularly high because this channel is tight. For the bears, they see this as a double top with either this high or the top of this sell climax. Very often when you get a sell climax like this and you get a reversal, the market tries to get a little bit above the top of the sell climax, and the bulls who bought the sell climax will take profits there, and the bears know the bulls will take profits, and the bears start to sell there as well. This is also about a 50% pullback from what the bears hope is the start of a bear trend. Both are reasonable reasons for traders to start to look to short. If they take that short, their initial stop is at the top of the strong bear leg. Here, the market did sell off, and many bears, because they think we have big up, big down, big confusion, and a trading range, if they sell here, we'll take profits around this low, thinking that we might get a double bottom and then a leg up in the trading range. The initial target for these bears is this low. In general, when you trade a major trend reversal, you have about a 40% chance of a swing profit. This is a good example of that. Despite the very tight bull channel, the bears were able to get down to a new low. In fact, they even got lower. And had they held, they would have had a reward that was many times greater than their risk. They sell below this bar, stop probably up here because we might get 1 more or 2 more pushes up after a very tight bull channel. Yet the math is worth it. Their initial risk is up here. Their actual risk, had they sold below this low, would have been 1 tick above the high of this bar, so the actual risk was tiny. And their reward at this point, partial profits at the new low, several times greater than the actual risk. And the final profit, if they exited down here or at the end of the day, would have been many, many times greater than their actual risk. And therefore, taking a trade that only has a 40% probability of success makes sense. Even if you get a swing profit only 40% of the time, it more than offsets the low probability of the trade. This is also a good example of how a reversal that's probably going to be minor is sometimes major. And therefore, it is reasonable to take the short and hold it for a swing. If you want a higher probability trade, instead of taking this short, you wait for a strong bear breakout with pretty good follow through. And unfortunately, you did not get that anywhere down here. We have a bear breakout to a higher low. It failed. And then we have gaps, this high, that low. Another attempt to get back above this low. And it's unsuccessful. A trader who notices that the limit order bulls who bought at this low were unable to get out with a profit. We did not get above the low here, did not get above the low here, and now we have a double top bear flag. This is, I think, a higher probability short because now you have a gap and you have trapped bulls who are desperately hoping for any kind of a rally to get out without a loss, and they will give up. Usually they'll give up when a low 2 triggers after the gap. Low 1, low 2. As I said, the actual risk was tiny. It's from your entry price, 1 tick below this bar, to 1 tick above that bar. That's all you had to risk to take this trade. You did not know that when you put the trade on, but once the trade starts to go your way, you do know that your actual risk was very, very small. Once you get a new low and there's reasonably good momentum in the sell-off, here, a very tight bear channel, traders will change their stop from up here to above this high because they'll see this as a major lower high. As long as the market stays below a major lower high, the bears have a chance of a continued bear trend. The bulls wanted to get a double bottom here. They tried, but they failed, and the market continued down. Therefore, another target on the downside is a measured move down from the potential double bottom. If the market did rally from this double bottom and broke above this lower high, traders would be looking for a measured move up. Whenever there's a potential double bottom like this, and instead of going up, it goes down, traders will look for a measured move down. And you can see what happened when the market fell to a measured move down. There were profit takers, and that led to this reversal. This reversal ended up forming simply a double top bear flag with this high. This is a reasonable place to take profits, either final or partial profits. We're at a measured move target, and we have a potential final flag, a low 2 late in a bear trend. We might get a bounce up. Because the channel is so tight, the reversal up will probably be minor. However, it could go up fairly far because we're at a significant support level, a measured move. Plus, we're testing yesterday's close and yesterday's low. And we have a potential final flag. And if you want, you can look at it as a wedge, 3 pushes, 1, 2, 3. Is this a major lower high? We have a strong breakout and a new low, but this is not much of a rally. Therefore, this might not be a particularly major lower high. When I look to the left, the most important lower high is still here. So theoretically, the bears can hold short even if we break above this high and this high, relying on this as their major lower high. During this rally, the bears still have a reasonable argument that we're in a broad bear channel as long as the rally does not get above this high. Again, this is a minor high. This is a minor high. This is a minor high. Because there was only a brief reversal up before the new low, I view this as part of this bear channel and this as the beginning of the leg down. If you look at a higher time frame chart, a tight bear channel like this is just a series of trend bars, bear trend bars. So this is still a breakout phase, even though we're getting repeated reversal attempts on this chart. Do the bears get out on the stop above here? Well, I think if you're thinking about getting out above a minor reversal, it's better to get out maybe here, a second reversal up. First reversal up, pull back, second reversal up, sell climax, late in a bear trend, a potential final flag. Therefore, if I'm choosing whether to get out early or late up here, those are my reasonable choices. This is not a reasonable choice because if the market goes above here, a minor high, it's probably not going to lead to a bull trend. It's probably only going to lead to either a trading range or a double top bear flag, which it did here. So this is not a really good exit location. If you're thinking about exiting before it gets above a major lower high, it's better to exit on the reversal up early and then look to sell again on a reversal down. I sometimes refer to this as a skunk stop because skunks get killed when they're in the middle of the road. And the middle of the road is either taking the early exit or the wide exit, and taking any of these minor exits in between is going to cost you money. Whenever the market's in a trend like this, bears will get out on reversals. Some bears might get out up here. I would not. If anything, I would be looking to sell again because it's only a minor lower high. Had a bear gotten out, he would have to look to sell again. And typically he'll sell below a bear bar. And here's a bear bar, or here's a bear bar. Those are two reasonable locations for the bears to sell again. If you sold for any reason here or below here, and you conclude correctly that the market's always in short, and then the market tries to reverse with the minor reversal, if you get out, here's another second entry reversal, first entry, second entry. You have to sell again below a bear bar, especially a second entry. Here's a first entry, here's a second entry, and this one has a bear bar. This is where the bears sell again, and this is where the bulls who bought give up. They might buy above here, maybe they buy above here, but when they see the bear trend resuming down a second time, they exit. And that usually is a profitable trade for the bears, a low too short and a bear trend. This is an impressive breakout on the part of the bears. You have 7 bars without a bull body. You have 4 bear bars with decent sized bear bodies, and it's the strongest series of bear bars occurring at least 20 bars into the trend, at least since here. And when you have the strongest bear breakout occurring late in a bear trend, it's more likely an exhaustive move, and the bears need to take a break. They'll buy back their shorts and look to sell again later. The top of that sell climax is a magnet, and therefore traders know that at this point the market's probably going to try to test this high. It probably will close the gap between these lows and these highs, which it did. Probably will get to this high, and the bulls who bought for a scalp, betting on a minor reversal, will take profits, and the experienced bears will sell again, arguing that even though it might be always in long here, it's still in a broad bear channel unless it gets above a major lower high. The same thing here. We have 4 consecutive bull bars, 2 with good bodies closing on their highs. The market might be always in long, but the reversal is minor because it's coming after a 10 or 11 bar very tight bear channel. Here, always in long. Here, probably always in long. But unless you're starting to form a series of higher lows and higher highs, this always in long and this always in long can still be in a broad bear channel, and therefore bears will look to sell the reversal back down, especially below a bear bar. Here we are at the end of the day. We have a bull bar closing on its high. Most bears would exit on a stop above the high of that bull bar. And if they did not, they would exit a few seconds before the end of the day. A lot of traders never worry about picking an exact top or an exact bottom. They use wide stops and they scale in. Pretty good selling pressure, a tight bear channel, 11 bars down, 3 consecutive bear bars closing near their lows. Again, the sell climax, so the top of the sell climax is a target. Think about what's going on here. We have a gap up, very good for the bulls, and then an 11 bar bear channel with several bear bars closing on their lows, good for the bears. We have big up, big down. That creates big confusion, and we're probably going to go sideways for a while. You can argue that we were sideways all the way to here. Also for the bulls, this is about a 50% pullback from this gap up, and it's a breakout test of this prior high. So it's at a support level. Traders expect a bounce. However, after big up, big down, they expect big confusion, which means a trading range, and that means they expect the first rally to not lead to a bull trend. They expect it to be sold and for the market to test back down. What they don't know is, will it form a double bottom and the bull trend will resume from a double bottom bull flag, bull trend, double bottom, and a resumption up? Or will this lower high be the start of a bear trend, a lower high major trend reversal. What they do know is big up, big down, big confusion, and therefore probably a trading range for 20 or more bars. And that means that any rally will be a bull leg in a trading range, and it should be followed by a bear leg in the range. But it might be a lower high major trend reversal leading to a bear trend. In either case, traders are going to look to sell rallies. A very tight channel like this, probably the first reversal down will be minor and bulls will buy it. And they did try to buy it. They bought it here, they bought it here, they bought it here, but not enough bought it to create the double bottom. And instead, we ended up trending down. We have 3 consecutive bear bars, 2 with big bodies, and all 3 closing on their lows. This is a bear breakout. Even though we reversed up to above the top of that bear breakout, it's still strong enough to make the market always in short. Some bulls will see this as always in long. However, this is a strong enough sell-off to make traders believe it's always in long, and the first reversal up will probably form a lower high and will probably come back down to test this close at a minimum at some point within 10 or 20 bars. If a trader sold the absolute worst price, like this close, if he manages his trade well, he'll still make money. He knows the channel down is tight, and therefore the first reversal up is probably minor, and that the market will probably test back down to this area. So even if he sells this close and uses a stop above the top of the sell-off, he can make money if he sells more higher, like at a 50% pullback or on a reversal down. And then he can exit part or all at his original price. He gets out break even for his entry down here, and he exits with a profit if he sold more here. That's for a scalper. A swing trader would hold until there's a clear reason to buy again. Strong bull trend, strong bull breakout, but a 1 bar final flag, a pause bar. You can argue parabolic wedge, 1, 2, 3, a small double top, possibly a second leg trap. This looks like a bull leg in a trading range, and then suddenly we get an exceptionally strong bull leg. Strong bull breakout, and it failed. I talk more about this in the videos on trading failed breakouts and climactic reversals, and in the videos on trading the open. Remember, this is early in the day. The day is just starting. We have a very strong breakout on the open. 50% of the time, if you get a strong breakout up or down on the open, it's the wrong way and it will reverse. As strong as this is, do not assume that it's the start of a bull trend. 50-50 chance it is, 50-50 chance it'll be an opening reversal, rally to some resistance level, we don't see any right here, and then an early high of the day leading to a bear trend. For the bears, they're going to take a chance. They see pretty good reversal down here. We have 5 consecutive bear bars here, a decent sized bear bar here, good follow through here. Traders who see this see big up and pretty big down, and therefore they expect a trading range. That means that traders will sell any rally after this much of a reversal down. Some traders will sell for a scalp. Others will take a chance that it's a lower high major trend reversal and that this is simply a bull trap on the open and that this is the start of a bear trend day. So it's reasonable to short, especially below a bear bar. You can call it a wedge if you'd like. 1 push up, pause, 2nd push up, pause, and 3rd or 4th push up. And now we have a micro double top. And it's a breakout test of the bears who sold below here or here. Possible lower high major trend reversal. 40% chance traders will get a swing down. In general, you could put a stop here because of the micro double top, but a lot of traders would keep their stop up here at the top of the bear leg just in case we go up a little bit higher. Had you sold below the low of this bar, your initial risk, if you put the stop here, would be from your entry price here to there. So it would be that height. and this would be 2 times your initial risk. If you were to sell here and exit here, you would be getting out with 2 times your initial risk, and initial risk is always bigger than actual risk, and therefore you'd be getting out with at least 2 times actual risk, and the math would be okay. So it would be okay to sell here and take profits here. That would be the minimum mathematical thing to do. When the initial risk is small, as it is here, you sell below here. If you put the stop here, your initial risk is small. It's usually good to go for a profit that is at least twice your initial risk. Mathematically, all you have to do is go for a target that is twice your actual risk to have a positive trader's equation. However, if the actual risk is tiny, going for a reward that small is probably not the best decision. I always make the analogy to working for a minimum wage. Is it acceptable? Sure. But is it ideal? Should that be your goal? No. And the same is true with trading. There are things that mathematically make sense. However, if they're minimums, they're not necessarily the best. Whenever there's a strong buy climax like this, there's a big magnet at the bottom of the buy climax and the bottom of the bull leg. And therefore, some traders who take this short will hold, looking to take partial profits at the bottom of the buy climax. Also, we have a developing trading range. If you want, you can call it a double top. You can call it a wedge rally. Swing traders should always be looking for swing targets. And usually when you take the trade, the targets seem unrealistic. And what you're saying is, well, maybe I only have a 40% chance of reaching those reasonable targets. And that's okay, because the targets usually are many times greater than your risk. And if you win only 40% of the time, you will make money. You can look at this as a wedge. If we get a bear breakout below the wedge, maybe we'll fall for a measured move down. You can look at it as a double top. Here's the neckline. Here's the measured move down. You could look at it as simply a trading range. And if we get the breakout, maybe we'll fall for the measured move down. If we do get to this measured move, it's very close to the bottom of this buy climax, which is also a magnet. We'll probably get down here as well. And therefore, you might, instead of taking profits at the measured move target, hold for a test of the bottom of the buy climax. The market often makes a two-legged move, a leg one, pullback, leg two measured move, and it comes out here around that measured move target. So it looks like some bears will be taking profits around here. And you can see what happened. When it got down to the measured move target, it reversed up. It's also fell a little bit more than the leg one, leg two target. It never reached down here. If you did not exit partially with a limit order here, if you did not exit partially at 2 times your initial risk, you have to be thinking about exiting above this bull bar. You have a micro double bottom, a bull bar closing on its high, a failure to get all the way down to the bottom of the buy climax. Remember, the bulls are hoping today's a bull trend day. When they see this and then this, they start thinking, okay, it's probably not going to be a bull trend day, but maybe it can be a trading range day, which means a very deep pullback and then a test back up near the high of the day. And therefore, bulls are looking to buy. And they especially want to avoid the market falling below the bottom of that buy climax, because if it does, then the bears have a reasonable chance at a continued trend down. If you see the reversal up with a bull bar closing on its high, most bears, if they did not get out here, will get out there, even if they were hoping to get out here or here. They know there's too much risk that this could be a second leg trap in a trading range day. First leg down, and then an even stronger second leg down, and then we're trying to reverse up. So for the bulls, it's a high two bull flag. Leg one, pullback, leg two, and a higher low. So buying back shorts above this bar makes sense. The bulls still are above the bottom of the buy climax, and it's possible that this is the start of a big bull trend. more likely big up, big down, big confusion, and the day will end up as a trading range, and whatever rally we get will be a bull leg in that trading range. Also, the bear trend might resume. It did not, but it might. Strong rally and reversal down, but did not get below the bottom of the bull breakout, and therefore it could simply be a deep pullback. Instead of a bear trend, we could end up in a trading range. At this point, traders are hoping for a bull trend, and they're confident that the first reversal down to here or here probably will be bought. Always reasonable to take half off at 2 times initial risk. Always reasonable to take part or all off at measured move targets. Always reasonable to take part or all off at the bottom of the buy climax or the bottom of the strong bull leg. But if it gets to any of the reasonable targets and starts to reverse up strongly, it's usually good to exit and then look to sell again higher if you're still interested in selling. Some traders would have a limit order to take profits at the measured move, or at least partial profits there. And you can see a lot of traders did that. That's what created this tail. And then once the traders saw this tail, a lot of traders said, uh-oh, maybe I should have taken profits at that measured move target. I'm going to place my order a little bit higher. The traders who did not exit here, a lot of them placed an order a little bit higher to take their profits, and that's what caused that. The bulls also saw that they were able to do this, and they got confidence that maybe we'll stay above the buy climax low, and they decided to buy more aggressively after they saw this reversal up. They bought below this bear bar, and enough traders bought, both bulls and bears. Bears bought to buy back shorts, bulls bought hoping for a swing up, and enough traders bought so that we did get a reversal. For the bulls, it's still above the bottom of the buy climax, and therefore a higher low, and what they hope is a bull trend, but after big up, big down trading range, much more likely. Bear leg in a trading range usually means you're going to get a bull leg in a trading range, so it's reasonable to buy to go long. We have a bull trend and then a trading range. We have a bull breakout above the range. If you want, you can call it a higher high major trend reversal. Then we get a reversal down, but then again another reversal up. This entire 50 bars is in a trading range, and it's getting many reversals, and most reversals fail. This top failed, this top failed, this one failed, this one failed, and now we're trying to resume up. We had a double bottom, another double bottom, did not go very far. We're trying to reverse up here, did not go very far. In a trading range, most breakout attempts fail, and you get repeated reversals. There are different ways to look at this. You can call it a wedge, 1, 2, 3, and a bull breakout above the wedge that failed and reversed down. You can call it simply a trading range and a higher high major trend reversal, a parabolic wedge, 1, 2, 3. In any case, we're trying to rally strongly and we are reversing. Lots of selling pressure here, here, and then especially here and here. This is enough selling pressure so that the bears have a reasonable chance of getting a trend down. The bulls have a trend up, and now it's very balanced, and the bears are very strong. Therefore, traders will start to look for a swing down. A strong break below the bull trend line, and a wedge rally, up, down, up, and starting to go down. A 2-bar reversal, a bear bar closing on its low. If you want, some traders will look at it as a double top, lower high. In any case, it is a lower high major trend reversal, and it's a reasonable swing short. The worst the bears expect is a continued trading range and a test near the bottom of the range, and they're hoping that it's the first of many lower highs and the start of a bear trend. If you take this short, it's reasonable to put your stop just above the high. We have a wedge and a good bear bar, or you could put your stop above the top of the bear trend, or what they hope is the top of the bear trend. If you short below this bear bar, I don't like to short below bull bars. I prefer to short below a bear bar closing on its low. So this is where I would short. If I shorted and I used a stop here, my initial risk would be the height of this brown box. And 2 times my initial risk would be here. And that's always a reasonable location to take partial or full profits, especially since it's at the bottom of a 50-bar trading range. Trading ranges tend to reverse at new lows and reverse at new highs. And therefore, there's a pretty good chance we'll get some kind of a bounce up down here. Mathematically, it's good to take profits at 2 times initial risk. Remember, the minimum reward that you want is 2 times actual risk. Had you sold below this bar, you would have been filled here. If the market goes down, your actual risk is only right here. Exiting with 2 times actual risk is probably too small given the size of the legs here. A bear who sold here, trying to exit at 2 times initial risk, has a limit order to buy back his shorts here, or he may simply place a limit order to buy back his short here, thinking that we're at the bottom of the range and it could reverse up. What do you do when the market is trying to go down, 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 but losing momentum? The bear bars are getting smaller. We're starting to get bull bars closing on their highs here, 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 and we've been in our trading range for 50 bars. This is a problem for the bears. They have a bear spike and a pullback. They're hoping for a channel, 3 pushes down, 1, 2, 3. And what they got was 3 pushes down, 1, 2, or 2, and 3, but they could not get below this low. And this is starting to base out. It's starting to go horizontal. Very strong bear breakout, terrible follow through, more bad follow through for the bears, more bars closing on their highs, bad follow through. Here, we have a bear bar and a doji bar, a bear bar and a bull bar, a bear bar and a bull bar. Therefore, there's a lot of bad follow through for the bears on the way down. There's bad follow through for the bulls on the way up. Bull bar, bear bar, bull bar, bear bar, bull bar, bear bar, bull bar, bear bar, trading range behavior. And now we're starting to get trading range behavior again after what the bears hoped was a lower high major trend reversal and a strong breakout. And they hoped this was the start of a bear trend, but terrible follow through. Bottom of the range. What do? You took the short, thinking 40% chance of a swing down. Now, this is making you wonder if your premise is correct. If you begin to think that your premise is no longer valid, you have to exit your trade. And it's reasonable to exit here. We have a wedge bottom, a higher low, terrible follow through after the initial sell-off. So it's reasonable to exit here. And is that a scalp profit or a swing profit? It doesn't matter. It's not what you hope to get, but it's a small profit. I would call that a break-even trade or a small profit trade. But that's what you get 60% of the time when you trade major trend reversals. You don't get a swing trade. You either get a small profit or a small loss. The market continued sideways, and we're reversing up a third time. First reversal up, second reversal up, third reversal up in a sideways market, and therefore it's a triangle. And we're reversing up from the bottom of the triangle. Another bear breakout attempt to a higher low, followed by a bull inside bar. Some bulls would buy above the high of that bar and get filled here. Others would wait for a second entry and buy above this bar and get filled here. I talked about lower high major trend reversals in this video, and like all major reversals, they have about a 40% chance of leading to a swing profit. By a swing profit, I mean at least 2 times your actual or initial risk. Usually you're looking for at least 2 legs and 20 or more bars. You get that about 40% of the time if you pick the right entries. Getting that only 40% of the time greatly offsets the low probability. It's a profitable strategy. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 4 videos on trading major trend reversal tops. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the fourth of 4 videos on trading major trend reversal tops. Some traders do not like taking trades where the probability of success is only about 40%. And therefore, they do not take the early entry in a major trend reversal. They wait until after there is a strong breakout, because at that point, the probability of making money is higher. We have a bull trend, and we have a series of bear bars breaking below a bull trend line, and now we're forming a lower high. Some traders will take that short, taking a chance that it's the start of a major trend reversal down. However, the probability of a swing down at this point is not all that great. We've been sideways for about 30 bars, and we're in a tight trading range here. For the bears who do take that short, they'll look at this and say, okay, 7 bear bars, several good closes on the lows. I'll short and put a stop above this high and take a chance that we get a swing down. That is a reasonable thing to do, but only about a 40% chance of success. Some traders do not like to win only 40% of the time, and they prefer higher probability trades, and they instead would wait and not take this short. An 8-bar tight trading range inside of a 20 or 30-bar trading range. Minor reversal likely. It's more likely that we'll just stay sideways, but 40% chance we'll get a swing down if traders put a stop up here. And that turned out to be the case. This is the 40% of the time when the market had a swing down. If a trader wants a higher probability short, instead of shorting here in the middle of this trading range, in this tight trading range, he'll wait for a strong bear breakout below here. For example, we have a bear bar, consecutive good-sized bear bars, and then we're getting another pair of bear bars here. At this point, we've had 5, 6, or 7 consecutive bear bars. It's higher probability to short either here or down here. After a trader sees this, he knows that the first reversal up probably will be minor, and he could look to sell below here. It's a wedge. We went up, we went down, we went up, we went down, we went up. So there's a wedge bear flag at the moving average after 7 consecutive bear bars, probably going down at least a little bit lower. And therefore, this is a relatively high probability short for at least a small move down. Now we have consecutive very big bear trend bars, and we have a follow-through bar and another follow-through bar. This has a high probability of leading to at least a small second leg down. So this is a high probability short. It's a bear break below what the bulls hoped was a high 2 bull flag. Strong bull trend, first leg down, pullback, second leg down. So they're hoping for a double bottom higher low and a rally. Instead, we got a breakout, and not just a breakout, but a strong bear breakout, a pair of very big bear bars, and follow-through bear bars. Therefore, traders will be thinking about a possible measured move down. The bulls were hoping for a double bottom and a breakout above this neckline and a measured move up. Instead, we're getting the bear breakout. Bears will be thinking this is possibly a measuring gap or a measured move down. So instead of a measured move up from the double bottom, the bears are looking for a measured move down from the double bottom. Here's the double bottom attempt, the bear breakout. Here's the neckline of the double bottom. The bulls want a measured move up. Because we're getting the breakout, the bears want the measured move down from the top to the potential double bottom and then down here. And you can see where the market ended up, almost exactly to a measured move down. For the swing traders, this reversal is probably the earliest swing short. Maybe you could sell up here, possible final flag early in the day, hoping that you're getting an early high of the day. But later entries here, here, or here often have higher probability. In any case, with any trade, the math is always reasonable if you hold for at least 2 times your actual risk. However, many trades have potential of much bigger profit, and it's usually better not to go for the minimum. Traders looking at this are saying, do I sell here? There's a low 2. Do I sell here? Do I sell here? Do I sell here? Where's the best entry? There is no best entry, and every entry is a trade-off between risk-reward and probability. The earlier entries tend to have a closer stop, so the risk is less. There's more profit potential, so the reward is greater. So the earlier entries tend to have a much better risk-reward. However, they also tend to have lower probability. The later entries have a much higher probability of success, but the stop is usually further away, and there's less profit remaining in the trade. Both are mathematically acceptable trades. It usually comes down to personality. A lot of traders will add to a winning trade. There's no reason to get out here. Maybe you can get out here, but if you do, you got to look to sell again. Strong enough up, a lot of bears will not take the first reversal down. However, they will take the second reversal down, even though it's a bull bar. It's a low 2 short at the moving average. This is not enough for a major reversal, and therefore it's a double top bear flag. It's a reasonable short. And bears who sold here, if they did not get out here, they might sell more here or here. If they did get out here, we're still always in short. The bulls have not done enough to make it always in long. They have to get short again if they're trading always in, and a double top bear flag, a low 2 at the moving average, is a reasonable time to get short again. If a bear took any of these shorts, let's say he took an early one and he sold more here or here or here or here, he's scaling into a winning trade. He's scaling into a trade where he already has a profit. The minimum goal for any trade is a profit that is at least twice your actual risk. You don't know what your actual risk is when you put the trade on, but once the trade goes your way, you then know what the actual risk is. For example, had you sold below the low of this bar, and then you see this bear breakout, you discovered that your actual risk was to just above the high of this bear bar. So your actual risk was the height of this brown box. Here's 1 times your actual risk. Here's 2 times your actual risk. Mathematically, it's acceptable to take your entire profit right here at 2 times your actual risk. That is the minimum acceptable profit to get a positive trader's equation. But like everything in life, doing the minimum is rarely doing the best. Again, if you sold below this bar and the market broke strongly to the downside here, at that point, you discovered that your actual risk was only from just below this low to 1 tick above this high. You had a very small actual risk, and therefore this is 2 times actual risk right here. And if you exited your entire position right there, and you did that on 100 trades, you have a very high probability of making money. But again, exiting with the minimum is rarely the most profitable strategy. Same thing here. If you sold below the low of this bar, your actual risk is to just above the high of this bar. You discovered that after this bear breakout, and 2 times your actual risk is right there at that bear close. It's reasonable to exit there, but it's probably not ideal. When the actual risk is tiny, like here, here, and here, exiting at 2 times actual risk is usually not a good strategy. You have much more profit potential, and it's usually better to hold for a bigger profit. Same thing here. Actual risk, you sell below that bar, you get filled here. The market breaks to the downside. You now know your actual risk was only from your entry price right here to one tick above this bear bar here, 2 times actual risk here. Some traders have a scalper's mentality and they keep taking quick profits, 2 times actual risk, and then sell again. Very difficult to do because what you'll find is you don't take all of the entries, and therefore you will not make nearly as much money as a swing trader. I talk more about this in the video on trade management and taking profits. A lot of traders do not pay attention to actual risk, especially if it's small, and they set their target at 2 times initial risk. Initial risk is based upon their initial stop. For example, had you sold below this bar and put a stop just above its high, your initial risk was 1 tick below this bar to 1 tick above that bar, and this is 2 times initial risk. Same here. Sell below this bar, stop above at the high, that's your initial risk. Here's 2 times initial risk. It's always at least as big as actual risk, and it's usually bigger than actual risk. And that is usually a better strategy. So it's always good to take profits at 2 times initial risk. However, it's not always best. And if the initial risk is small and you have the potential for a very big profit, it's usually better to not exit at 2 times initial risk. It's reasonable to take half off or part of your profits at 2 times initial risk. However, if the potential for profit is much greater, a lot of traders will continue to hold their entire position until they believe their premise is no longer valid. If their premise is that the market's in a strong bear trend, they'll continue to hold short until they think it's no longer in a strong bear trend. Had you sold here and had not taken any profits along the way, here, a pretty good bull reversal bar, a double bottom, a second failed breakout below the bottom of yesterday, it's reasonable to take partial or full profits here. But if you do, the market did not get always in long here or here. You have to be thinking about selling again below the low 2 at the moving average. Initial risk for the bears who sold below this bar, their stop is probably here. And this is 2 times initial risk. It did not get down to their initial risk by the end of the day. And if that was their goal, they would exit at the end of the day. Again, it's reasonable to hold your position until either the end of the session or until there's a reasonably good buy signal. The market keeps trying to reverse. Every trend is constantly reversing. On the way up, the market tried to reverse repeatedly. On the way down, it's trying to reverse repeatedly. But when the market's in a fairly tight channel like this, 80% of the attempts to reverse up will fail and become bear flags, and the trend will continue. Every time there's a strong breakout to a new low, traders will tighten their stops because here, you get a strong breakout to a new low. Therefore, this high is important. It's major. And as long as the rally up stays below the major lower high, the premise of a strong bear trend is still intact. And therefore, once you have a strong breakout to a new low, traders will tighten their stops to above that high. If it gets above that high, then the premise of a strong bear trend is no longer valid. The market's then either in a trading range or in a bull trend. And if you're holding on the belief that the market's in a bear trend, then it should not get above this high, and therefore it's reasonable to put your stop there. Strong bear breakout, reasonable to lower your stop to here. This then becomes a major lower high. After this close, it's a strong breakout to a new low in a bear trend. If the bear trend is going to continue, it should not get above this high, and therefore you can lower your stop from here to here. strong bear breakout to a new low. If it's in a bear trend, it should not get above that high, and therefore you could lower your stop from here to here. And that does not matter whether you shorted here or shorted here or shorted here. Your stop location has nothing to do with your entry. Your stop location has to do with what the market is doing at the moment. Another strong breakout, new low. This is therefore a major lower high. And if it's in a bear trend, it should not get above this high. And therefore, if you're holding short on the belief that it's in a bear trend, it's reasonable to tighten your stop, to trail your stop down to above the most recent major lower high. And you keep doing that until either the end of the session or until there's a reasonable buy signal, and then you get out. Your premise is that it's in a bear trend, and therefore it should be forming lower highs. And if it stops forming lower highs, then it's no longer in a bear trend. Is this a major lower high? We have a strong bear breakout, but only one bar did not get to a new low. Therefore, this is not a major lower high, and therefore traders should not lower their stop from here to here. And you can see this high looks like it's a little bit above that high, and most bears would hold short. If they did not get out here, they're not going to get out here. They'll rely on their stop up here. When the market's in a bear trend, it sometimes has pretty strong looking reversals. We have a bull bar here and an even better second attempt to reverse up here. However, the channel is tight, the entire trend is tight. As long as it's not going above a major lower high, this is probably going to be a bear flag or a trading range. We get a strong enough reversal up so that we'll probably get at least a small second leg up. But unless we get above this high, this is just going to be a double top bear flag. Or you can call it a triangle. We went down, we went down, we went down. You can call it a wedge. We went up, we went up, we went up, even though it's not a wedge shape. In any case, it's much more likely a bear flag that will lead to a resumption of the bear trend than a reversal. It's too small a pattern to be a major reversal, and therefore it's probably a minor reversal, which means a bear flag. If a trader exited, he would sell again here. If he did not exit, he might add to his position here, double top bear flag at the moving average. When you took this trade, if you took this, you knew you only had a 40% chance of a swing down, 60% chance that it would either go sideways or possibly resume back up. But your risk is relatively small compared to your potential reward. Most successful swing trades end up as trading ranges. Sometimes after a small swing profit, sometimes after a big swing profit. This is a bear channel. A bear channel is a bull flag. 75% chance we're going to get a bull breakout, and this entire bear channel will evolve into a trading range. Maybe the top of the range will be here. The most recent really major lower high might retrace the entire trend. Here's a 60-minute chart showing what took place over the next 3 days. This brown box is this brown box. This is the 5-minute chart. This is the 60-minute chart of this same 5-minute chart. And you can see that even though it was a strong bear trend, the next day it reversed up, and it reversed up for several more days. And therefore, even though it was a successful major trend reversal down, it ended up reversing into a larger trading range. And in fact, it went above the top of the bear trend. 2 days later, it was back above this high. Therefore, when you see a major trend reversal on the 5-minute chart, don't assume that it's going to lead to a trend down for the next 5 days or 10 days. It's probably going to evolve into a trading range within a day or two. However, it's still a very good profit for a day trader looking for a swing trade down. What do you do here? We have a bull trend, and then a higher high major trend reversal. But we're at the end of the trading day. It's a higher high major trend reversal. It's an okay swing trade, but one problem you have is there might not be enough time for a swing. It could just go sideways, but it's a reasonable short. You got a bull trend and a high 2 bull flag, a double bottom bull flag at the moving average, but it's late in the trend and it's near the end of the session. It might be the final bull flag. That means that if we get a new high, it could be the end of the trend and we could get a reversal back down into the final flag and either a trading range or a sell the close finish at the end of the day. We have gap bars, although you might not be able to see it. There's a gap between the high of this bar and the moving average, and then again here. When you get moving average gap bars late in a trend, they usually lead to a major trend reversal attempt around the prior high, and therefore that's another reason to be looking to sell here. MAG, moving average gap bars. If you take this short, you really need signs of strength because you're right at the end of the day and you really don't have that much time. Most of the bears will get out, especially above a second bull bar here, first bull bar, second bull bar. They'll get out above here. And look what happened. This high went exactly to the top of that bull bar, but not above. What does that tell you? It tells you that the bears were able to prevent the market from getting above this bull bar. They know that a lot of the bears would exit there, and they know the bulls were trying to get it above there. But it got there and turned down. That's a good sign for the bears. They were able to stop the bulls from forcing the bears out, and that means we're probably going lower. And now we have a 5, 6, 7 bar bear microchannel, and it became a sell the close finish. You're at the end of the day. If the market's not going your way, you have to get out quickly. For example, we have 2 legs down, 1 pullback, 2, and a bull body. Even though it has a big tail on top, most bears would get out above that bull bar because there's just not much time in the day. And if it starts to go up for a few bars, you'll run out of time before it can go back down. My general rule is if it goes 1 tick above a bull bar, I get out. If it goes 4 ticks above any bar, a small bull bar or a bear bar, I'll get out at the end of the day. And bears will take profits at the end of the day, the final seconds, the final minute or two. Very strong bull trend. A higher high major trend reversal. We broke above the bull trend and we went up, bad follow through, and we're reversing down. We have a bear bar. It's a reasonable short looking for a swing down. You have a biclimax, the strongest bull breakout very late in a bull trend, probably an exhaustion bar. Exhaustion does not mean reversal to an opposite trend. It simply means usually a pause in the bull trend, but it can lead to a reversal, and therefore it's reasonable to short below that bear bar. Small 2-bar final flag. If you take that short, what do you do when you see this bar? You're saying, oh, that's a double bottom, and it could be a double bottom bull flag. This whole thing could be a big bull flag, a pullback from this very strong small pullback bull trend, and you have an exceptionally strong buy signal bar. If you take this short, you have to get out above that bull bar because the bulls have a reasonable argument for this being a double bottom bull flag. It could not fall below the bottom of this strong reversal up. Therefore, this is a major higher low, and the bulls got down to it, but not below it, and now it's resuming up with a very strong bull bar. Sometimes you take a short, and it's reasonable to take the short, but if you get a reasonable buy signal after you take your short, you have to get out, and that's what took place here. It's hard to reverse. If you took that short, it's hard to reverse to long here, but you have to get out of the short. And if you did not take the short, it's reasonable to buy here. If you did get out of your short here, you can wait for 2 or 3 bars and then buy, maybe buy this close, or buy above this bar, a wedge bull flag to the moving average, down, up, down, and then a bull bar closing on its high. Most traders do not like to reverse, even really experienced traders. I've been trading for 30 years and I don't reverse all that much. I prefer, if I took that short, I would get out here and then wait 1 or 2 bars and then look to buy if I wanted to buy. In this video, I talked about how a lot of traders don't like the initial entries for major trend reversals because the probability is usually only 40%. While a 40% probability is still good if you have a reward several times greater than your risk, some traders prefer to wait until the probability is higher. In other words, they wait for a strong breakout and then they enter. Both approaches are reasonable. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on trading major trend reversal tops.